Hello to everybody as we think about what does the business landscape look post-COVID. I'm excited to share with the group on everything I know at least through today. My name is Mike Bosma. I am the managing principal of Keystone CPAs, and it's one of those things. I always, for lack of a better term, revel in all things technology. Think this time last year, I was like, every meeting was at Zoom, but I really hadn't really knew anything about Zoom. Or I knew a little bit, but I would never go to a Zoom meeting, but now I actually prefer them. So first I want to do is divide this hit with a little bit of a market update. And I have a lot of people. I'm the CPA by trade, but most of my clients, my friends, are all my age. So we're all thinking about how to retire, air quotes. Nobody ever retires anymore. They just don't want to go to the office every day. So they're thinking, well, what do I do? And so what's the market look like? What do I do? And I would say from a market perspective, there's things that might indicate there's a bull market. Things are opening back up. The jobs are going wrong. There's a lot of stimulus money that has been pushed into the economy. And by and large, things are robust, to say the least. But then there's also bearish signals. Market, if you look at how the price earnings multiple of many stocks that are traded or the indexes in total, as Linda Lovey would tell you, it's a little rich on the valuation side of the equation. Also, there's inflation concerns, and that the Fed is going to have to pull back some of its policies that has got the economy going. It might be just going at a clip a bit too much, and it's starting to already see some increase in interest rates. So basically, I think what we're all going to expect is a lot of volatility in the market, and put a placeholder in that, because we're going to get to that for some planning in a minute. The other thing that is interesting, when you think about interest rates that in the pandemic were basically near zero. Now, if you go from a half a point to even a modest rate of 1.53, that still is a 3x of what it once was. So, and I think the Fed is already starting to talk about what they're getting, some concerns there, but I think right now they're getting a lot of pressure from the White House to keep things chugging along. And then talking about the potential inflation showing up in commodity prices, they're starting to see that trend already. You might have seen some memes about the cost of lumber and some things like that. My general contractor on a project I had showed me his pricing was 4x what it was last year. Now, it's interesting on the real estate side of the equation. Reno, North Nevada has really profited from the rise in real estate. And one of the things that I would just look as you look at this chart, there's a lot of data on the chart. Some sectors are killing it. If you had concrete tilt up industrial, your rates are getting close to what offices are renting for right now. If, on the other hand, you were a poor soul who had a retail like a mall or lodging, not so much. You're thinking, where is all this upside? And I think what's happening now is you're seeing a lot of consideration given to repurposing retail, especially now people are buying everything online. That actually now prefer doing that for many things rather than going to the mall. Even post-COVID, I think a lot of people are really thinking, I just don't know how safe it is. I know I got COVID in December of last year, bled over into this new year. But I thought up until that time, like, this is the healthiest I've ever been. I usually get sick once or twice a year, but I'm like, because I wasn't around anybody, wore masks all the time. How can you get sick? You live in a sterile bubble. I think people are like, that was a better way of life, and especially for the introverts of the world, they preferred it, so they now can. So, but if you've got a bunch of retail, maybe not the place to deploy capital. But if you have capital, now those valuations, I think, are very, very nice, and you can buy some retail at a discount. Of course, as a business perspective, anytime you see people running from an area, that's where I charge into. That's where the opportunities are. And then if you look at some of the private change in private values versus pre-COVID, industrial up 14 and mall down 20. So it just depending on what hit you, and that's where we talk to people about what their experience was this last year and a half. Some people killed it, other people got killed, and it's just how it is. So the other thing is rebound in unemployment is still uneven. So, and I think right now, pretty much every business owner I talk to them daily, says getting people is near impossible. It's very, very difficult. And I think those are things where you look at, hey, we're trending back up. We had this huge dip, trending back up, but we're still not back to that employment that we had pre-COVID. And basically, the word on the street is that the current unemployment practices, or there's just people that'd rather stay at home, watch the kiddos, especially since there's distance learning through the end of this last school year. And they're just saying, hey, I'd rather just stay at home and collect unemployment. And they really have no interest in going back to work until they have to. Now, what's really interesting there is when all these people roll off of unemployment, I think you're going to see a surge in real opportunities. So I think that those are things, if you're an employer, you've got an ear to the ground on when those unemployment benefits start to lapse so that you can get in full recruiting mode. Of course, you have to not be all irritated and agitated that people were on the public dole for a minute, enjoying the fruits of your labor. And then this uneven job recovery across industries. There's all kinds of data out there that will tell you, things are a fraction of what they once were, even though it feels. If you look at the news, you'd say, oh no, everything's fine, but most business owners would say it's not fine. Had it not been for the stimulus, the PPP, many businesses would have been bankrupt. The other thing that I want to be able to talk about was the Biden tax plan. Now, what's interesting about the Biden tax plan is that he was very visible with it. It was on his website, for example, when he was running for president, and I think that just really underscored his belief that he was going to get elected and didn't want this to come back like a George Bush the first type of situation where he gets backed into a corner and saying he's not going to raise taxes and then did and be a one-term president. So Biden said, no, we're raising taxes. All this money we save for the rich, more on that later. So you just need to understand that what the difference is. This little chart has just a spread between 37% top rate now and Biden's proposal 39.6%. 20% top capital gains rate versus 39.6. Removing the capital gains is hurt me. And then a lot of business owners on this call will do business in an S corporation, so they don't pay self-employment tax on the earnings of that S corporation. And they're saying, oh no, you tax swindlers, you need to pay like the rest of us. So then they throw that 3.8% Medicare and FICA and Medicare and throw that at you as well. And then on all the income from the business, regardless of the type of business, I think you're going to see a lot of people to say, if that happens, I'm just going to be an LLC. I don't have to file taxes anymore. I was reported as Schedule C on my income tax return rather than having to file a separate corporate return. And then income taxes on estate tax, basically estate tax 11.5 million per person. Most people don't have to worry about estate tax. And now they're saying, oh no, we're gonna have an income tax on any appreciation on your estate over $1 million. And then they're out. Then you can do a like-kind exchange if you have real estate, for example, and you want to sell it and then buy another piece of real estate. You can roll that gain over. So think of it this way. So I know numerous people. They build the fourplex and they live in one of those units, and that kind of gets them going. So they can basically the rent from the 3 of the 4 pays the mortgage, so they get rent free, and then they accumulate a fair amount of wealth there. Well, they can sell that fourplex once it's rented. It costs less to build than it would once it's rented as a multifamily property, and then they could double down, go into an eightplex, and could do the same thing. So what this does, it limits that gain to $500,000, which a lot of real estate people. I think this is the F. Donald Trump plan. Think about he got a lot of grief for not paying taxes, and when if you're a real estate, you can just keep rolling these gains over until you die and never pay tax on it. So this is how that went. What about corporate taxes? Not a lot in the news on that, but according to Tax Foundation, under the Biden tax plan, the U.S. would be the top 65 percentile. So basically, if you're looking at this slide, and you can see, oh well, gosh golly, gee whiz, from a competitiveness perspective, we're, at best, we were, not on the top, 2/3. And now, we're back to kind of even worse than we were before. And that's why, it's interesting when the U.S. cut their rate, it really led many other nations to do the same, so that they weren't so that they were competitive against the United States. Now, the other thing that you just have to appreciate about this mess that we're in is that what got little press is that what Donald Trump did when he did tax reform, he said, hey, but all those offshore profits, all those Ireland companies are only paying 10%. You got to pay all that tax. You're bringing all that money back into the United States. So they paid billions and billions of dollars of income tax, because they said, well, but we went from 34% to 21%. So, okay. Well, now, he's not talking about undoing that. So now that, all this income that's earned offshore, it's still being taxed, but now he's going to, jack the rate from 21 to 28%. And there's really nowhere to hide now. It used to be pretty easy to hide money offshore. So, it's kind of like this perfect storm of mess for corporations. Well, think about how that relates to the stock market. The stock market under Donald Trump had quite a run, even through COVID. And I just have to imagine that there's going to be a significant softening of stock prices once you take a chunk of that wealth away, just in the form of taxes. By and large, these companies are bought and sold based on what they earn. And I think the tax tip to the savvy business owners would consider is reverse tax planning. Now, that's a non-sophisticated way to say you might want to pay more taxes today, because most tax planning is just about accelerating deductions, getting deductions in the right year. And what I try and help people understand is, in the concept of business owner, you have these peaks and valleys. It's cyclical. Sometimes you're killing it, other times the train's coming down the other side. And you want to just be able to have a good, even, effective tax rate based on how much you're earning. So a lot of times people will say, well, gosh, if I can generate a big loss in a year, well, you might not get the benefit of the lower tax brackets. And when that, you take a deduction one year, you don't get one another year. So when that comes unwound, you don't get the deduction. So maybe I got a 15% benefit for the deduction. I don't want to pay 39% on the other side of that. And I just can't earn enough in the interim, especially at 1.5% interest rate. I just can't earn enough to make that tax spread worth it. So, just reverse tax planning is going to be something you will see more and more of. Now, this slide talks about the married tax rate. So what are the impacts to most people? So you can see that currently you got an income tax rate goes from 10% down to 37%. So under the proposal, this is what ends up happening. So this top rate, the second to the top rate, kicks out at 509 instead of 600, and then you end up at 39.6% of the excess over 509,000. So if you're a million, so like trying to help people, does this matter to me? If I make $1 million, it costs me an extra 15 grand in taxes. Boo-hoo, does this? Why are we even talking about it? Well, the capital gains thing, which has really not gotten a lot of play at all, because everybody's talking about, taxes are going to go up. It's really not going to be that much. But removing the capital gains rate is a game changer for many people. And really, capital gains is this concept. I remember when we went through the 90s and 2000s about kind of getting some normalcy in capital gains rates. You're taking all the gain in 1 year, and that's going to stack up the rates, the progressive tax rates as your income goes up. So currently, top capital gains rate 23.8%. That's 20% capital gains rate plus the 3.8% net investment income tax rate. That new proposal goes from 23.8 to 43.4. Tax rate on average 5.2%. So what that means is you hit the 43.4, and some of these states like California, 13.3, you're paying over 50% in taxes. So basically, you pay more in taxes, you pay more than you keep. Now, how does this work? The same, if you had, instead of having $1 million of salary, you have $1 million of capital gain. you're paying over $200,000 more in taxes. Now that is enough to get your attention, because what once was, in round numbers, $230,000 in taxes, now $430,000 in taxes. And so it's just, why should I sell it? So the tax tip now, under Biden's proposal, he's repealing the capital gains rates, but he's not repealing Code 453, which is installment sales. So basically, let's say you sold your business, you're going to want to spread that income instead of take it all in one year and get top out at that 43%. You're going to want to take it, so because like most people that sell their business, they just don't have the income in subsequent years. So you're just going to do planning to mitigate the one-time hit and then spread that tax out over. In fact, there's it's fun, right? There's a 0% capital gains rate right now for married filing joint, about 80 grand taxable income. So you could, if the law is structured correctly, or if you plan correctly and the law doesn't remove that 0%, you could go from 43 to 0% with proper planning just by spreading that income out over years. The other thing is that this Medicare tax proposal. Finally, this is the quote, finally, high-income workers and investors generally pay 3.8% Medicare tax on earnings, but the application is inconsistent across taxpayers due to holes in the law. The president's tax reform would apply the taxes consistently to those making over $400,000, blah, blah, blah. So, because they're like, oh, it's a loophole. Well, the thing, because presidents except for Trump, put their tax returns out there. So how did Joe Biden do business? He routed, because many politicians, they either do speeches or they write a book, and that's how they make their wealth. And it's funny because I just say, wow, Joe Biden, he has an S corp, right? And all the money he made through his books was routed through S, paid himself a reasonable salary, saved $500,000 in self-employment tax. So nobody ever talks about that. So he's saying, he's taking advantage of all the same loopholes he's accusing everybody else of doing. So anyway, all these things I find fascinating, probably nobody else does, but that's okay. So the current law, let's say you had Bo as a tell-all contract with a publishing company for $14 million, and Joe, as in Joe Biden, he has an S corp for the same contract and runs that through the S corp. So Bo pays $500,000 more in taxes than Joe because it's the self-employment tax on $14 million doesn't kick in. Now under the new proposal, Joe ends up getting rung up with a $494,000 tax on the business income. Now the unfortunate reality is this: in S corporation land, you can't unwind an S corporation tax-free. You can't do it. Those assets, you're making money. The company, even though you may not have hard assets, physical assets, you have intangible assets, and they have value. And so you're like, well, hey, I'm just going to unwind my S corp. I'm going to do business in an LLC. Well, you can't do that tax-free. So you really have to get creative. If you're saying, well, heck, if this thing passes, now I got to pay to get my W-2 done. I got to pay to get my S corp file, and I'm paying the same tax if I was a single member LLC. Just put it on my Schedule C and my Form 1040. But I was like, well, I'm just going to shut the S corp down. Well, then now because there's no capital gains rates, let's say that your company's worth $1 million. That's now taxed at 43%. So it really is you did your planning under one regime, and now you're stuck with it, and it's just unfortunate. There's the law of unintended consequences. Anyway. So the other thing that the Biden proposal is doing is killing, in essence, the estate tax. But he is saying that hey, we're going to keep. You can still donate your wealth to charity. So think the Clinton Foundation, right? So you can run your own private foundation. In essence, keep. There's ways to get there. You just have to be more sophisticated than you've had to in the past. One of the things they haven't addressed yet is lifetime transfers and the changes in estate and gift tax rate. So that's an important one because you can still prior to this change, move your move your wealth around to take advantage of the current 11.5 and change of million of exemption, unless that, of course, goes retroactive. Now, so let me just say that. So on this slide, what it does, it gives a perspective of what the impact is for folks on this. So let's say I've got an $18 million estate that's shares of Ralston and General Mills. Get $17 million a gain under the new proposal. I'd have, because I'm still only exempted at 11 million of exemption, I still end up with 2.7 of the state taxes, but I end up with 6.9 of income taxes. Isn't that fascinating, right? So you think, well, gosh, that's a significant, as a percentage. If you just say, okay, I grew this wealth, now paying, and I've got an estate of 18 million. So I'm paying 18 million of value I have 2.7 of estate taxes plus 7 million of income taxes. So, basically the government gets 50% of your estate when you die. And so, from the tax tip on that one is, if this thing passes, you're really going to get smart on estate planning, kind of back prior to when they increased the exemption amounts, similar estate planning, and you're going to have a different perspective on how to bleed out that gain. Like, you wouldn't hold this 200 shares of General Mills till death. You would start selling that on some weighted average basis so that you can get the lower ordinary rates on that rather than all hitting at the end. And then like-kind exchanges, many of our clients in Reno have commercial properties, same for me. And what this proposed change is doing is eliminating the like-kind exchanges on real estate. So, current law, there's no tax, there's no limit on how much you can do. The business must be held for productive use in a business or investment property. And you've got some deadlines. You must identify the replacement property 45 days, must replace it in 180 days, that kind of stuff. You can't get the cash as a go to qualified intermediary. But they're saying is, and since 2018, you can't do it on tangible personal property, only real property. So, okay, so for example, here the property is sold for 10x, no gain reckoned as 2021. They buy the replacement property for 10x, and then their basis goes into the new property. So if you had a bunch of appreciation, you're not going to pay any gain. The proposal, on the other hand, would limit the like-kind exchange to 500,000, which, if you've got any kind of real estate, even a rental house, a single-family rental house here, it's entirely possible that if you bought that at the right time, you've got over $500,000 just on that single-family residence. So there's some open issues that are not addressed in proposed legislation. It doesn't say if it's per individual, per taxpayer. Is it per year over several years, and is it per disposition? So is that 500? If I got that would change. Do I do multifamily, or is it or should I have four in single-family residences? And then are those determinations made at the entity or the partner level? And then what is the effective date? So there's some big questions right now, but still, it's $500,000 not a lot. So now this is an important one here that Janet Yellen and many people in the know now, because the Biden proposed legislation is slated to take effect this year, 2021. And so you just have to look in your crystal ball and decide what are the chances that's going to happen? How do I plan accordingly? So Treasury Secretary Yellen, this is a quote from her, and she just said, hey, this thing is going to have a prospective beginning rather than retroactive. Both Ways and Means Chairman Neal and Finance Chairman Wyden earlier this year, they reaffirmed their opposition to the retroactive tax increases. So then the sticky wicket here is, what do you do? What do business people do now? and especially like if you have your business. So if you're, and what I would say is if you're going to sell, if you know you have to sell something in the next 4 years until the next election, if you know you're in jail, you're going to have to sell them. If you can get the right value for it, it's a good idea to sell it now. That way you take a lot of that off. Now, if you sold it now, and then they did make it retroactive for all of 2021, then what? Well, if you're going to have to sell in this time anyway, consider installments it, because at least then you can spread it out over that same time period. Now, I would tell you, because I also help people buy and sell businesses, that a lot of people would rather get cash in the barrelhead when they sell their business, so they don't have any risk that they're not going to get paid everything they sold their business for. And this one, you just have to weigh, especially with a 43% tax rate. Right? What's the risk of me not getting paid versus the what I know I'm gonna, the money's gonna leave the building in taxes if I just get all the cash up front. So, and that I think is just an informed decision that you have to make on how those things work. So, it's not easy. Let's put it that way. And then the other thing I would say in 2021, or I could say if you wait until the law is passed, and I think some portion of this thing will pass. I think the only way that would not be true is if something traumatic happened, which obviously we don't hope for. So it's kind of like on the current trajectory, they're like, no, we're going to pass this thing. They may end up giving some of it back just to get it through, just so they don't filibuster it to death. But you could wait until that legislation looks like it's imminent and then decide what to do. But as somebody who specializes in buying and selling businesses right now, for example, if you're going to sell your business, and I would say the same is true for the market. If you know you are going to sell, so for example, I'm helping a person right now buy a business, and he's selling Bitcoin. So, and if you follow Bitcoin, it's a roller coaster, but it's he's done well. Let's put it that way. He's done well on Bitcoin. And when I tell him, it's like, well, you're going hard on, which means in his purchase contract, he is going to have, his money's going to become non-refundable, and he's going to have to come up with a big chunk of cash to open escrow. You might want to consider just getting that done today or soon, because you don't know what tomorrow's going to bring. And the closer you get to this eventuality that we lose capital gains rate, there's this tax on S corps, whatever, that it's just, then there's this rush of activity, and I just think you're just going to see these crazy market fluctuations. I like right now, if you have a business that you're going to sell, it really is a seller's market. There's not a lot of business out there. People during COVID, they pulled their businesses off. They doubled down. They pressed in, and now there's more buyers because there's so much capital out there. Because there's trillions of dollars of infusion. There's more people looking to buy now than there ever has been. And so because there's capital chasing few deals, if you're a seller, you're in a good spot. But if all of a sudden, I'm 55. If you're 55, 65, and that, gosh, golly gee whiz, I got to sell my business in the next 4 years, and you wait until everybody has the same epiphany when, like, you mean if I sell it in 2022, I have to double the taxes? Everybody's going to list their business for sale, and then I believe it's going to flip from being a seller's market to a buyer's market, and eventually where the equilibrium is where what you're going to lose both ways. You're going to either lose it in taxes or you're going to lose it in the value of the business, and people are just going to say, I'm done, I'm over it, sell it. And so just, this is being recorded, so Dave, you can mark my words that, so if all of a sudden the legislation passes and there's still no business for sale, I'll apologize, but I just don't see it happen. I really don't. And then lastly is gifting. So, if you've got an estate over $1 million, and if you, for crying out loud, if you've got a house in Wingfield Springs, your estate's probably over $1 million. It just is. So, you got to stay over $1 million and they ratchet this thing back. You just got to consider, like let's say, for example, you're 60 years old and you've got enough in the bank and you've got, a bunch of appreciated stock that you really like. In the prior example, you had, Ralston Purina, right? And you're like, well, you could sell it, true, but I think in 2021 you may consider gifting it. Like, hey, this is what my kid's gonna die with, and I'm just gonna gift it to him. Or you can put it in like an LLC that has non-voting interest in it, and then you can gift a chunk to him without letting the little, that you're 60, your kid's probably 35 or 40, but without giving him access to the cash, be like, I got to get this out of my estate. So there's ways to do that. And the key is you want, like if you're going to gift, you want to gift it when there's a kind of a blip in the market, when it's less rather than more. A lot of that, talk to a financial expert to try and figure out how that crystal ball works. But I picked kind of the top Nevada things that you just need to put on your radar. Now, the thing I love about the great state of Nevada is that, if you as a business owner have an opinion on this stuff, you can really get a hold of your legislator and say, hey, be smart about this, okay? So what I did is I just kind of picked let's call it the Bosma 17 things from a Nevada perspective you might want to think about. And I think this is from where did I grab this from? It's Nevada Policies 2021 Legislative Tracker from NPRI, I believe. Just make sure I'm giving credit where credit is due. So the first one, AB 141. This is their analysis, not mine. But the proposal erodes what Nevadans have left of their property rights. So think of it this way, right? So you I'm a business owner, I'm a CPA by trade, and so oftentimes business owners come to me like, okay, Bosma, I need to grow my wealth. I'm maxing out my 401k, my retirement plan, blah, blah, blah. Like, what's the next thing? Well, you'll buy a piece of real estate, especially the one that you're renting. You'll rent to yourself, and that'll create some wealth for you. Yay. Well, and then the best one is like, hey, you'll rent from somebody else. So I've got multiple tenants in my commercial office building downtown Reno. And then not only are you paying your own mortgage and paying your own rent, but now somebody else is, and the rest, as they say, is history. But under a couple of these proposals, if you're a landlord and you couldn't kick your tenant out who's not paying, well, guess what? In essence, there was no COVID relief for landlords. Zero, nada. You by and large, you don't have employees, so there's no love there. Best you can do is work. If you had an SBA, they give you some love, but if you have a standard bank loan, you just got to keep making your payments. And then if heaven forbid you're in a retail situation where back when you couldn't evict your retail tenants, last year, I think, which ended in June or August, I can't remember, but imagine, you're like, I can't even kick them out. They're not paying rent. And if I could find somebody else to give them, I can't even do that. So they're holding my property hostage. And talk about an erosion of a right. You own, air quotes, own the real property. And then the government says, hey, you can't, sorry, you're not getting paid, but you can't evict it. It's terrible. And so basically this is, this provision, AB 141, there's a couple more that follow, are eroding real property owners' rights in that. And if you own real property, you already know it's hard enough to get people out when they don't pay. AB 184 creates Office of Small Business Advocacy within the Office of Lieutenant Governor. NPRI is not a fan of GoEd. They're not a fan of government, but I believe GoEd, because I've been around Nevada politics for almost 30 years, actually did consolidate under the governor's office a lot of that credits that are given to companies that relocate here. And like them or not, those credits, those incentives that we give out, if we don't have them, we're just not competitive with them. We can't, Nevada doesn't exist in a bubble. We just don't. So if other states are doing it, guess what? We get to too. Or we just don't get and unfortunately, what we're finding from people moving here, we have still, and EDON, great organization. Mike Kazmier's done a great job putting a team together, which I guess in the way of shameless self-promotion includes my son. I just, they've done a great job, but Texas right now is kind of kicking our butt, and they just said, hey, we're gonna make a very business-friendly place, and we've just leaned more towards, we're just not, our go-to market strategy is we're not as bad as California, not overly inspiring. But I think having this thing in the Lieutenant Governor's office is something you want to put on your radar screen. It used to, economic development used to reside solely in the Lieutenant Governor's office before, I think it was Governor Gwynn. Don't hold me to that one. Took it back. Anyway, AB 203 revised provisions relating to certain proceedings concerning evictions. Again, same thing. Hey, they're limiting our ability to kick out people that don't pay. Now the other thing is that, so people say, well, what about affordable housing? What about and I have a landlord, and he's all leased up, and I just was kind of talking about, well, what happens if have you had this problem with the governor saying you can't evict anybody? He goes, no, everybody that I rent to, I know they're going to be able to pay their rent. I'm like, well, how do you know? He goes, oh, I only rent to people that work for this or that, and they're recession proof. I'm like, oh, it kind of this a lack of ability to evict somebody in essence ended up creating a situation where landlords are like, if you're in the hospitality industry, there's no way I'm going to rent you, or if I do, I'm going to have this big deposit. It's going to cost you more because you're in an industry that I think is at risk. This is how landlords look at it. So I don't know there's a way to right size that. AB 330 establishes provisions governing occupational training and licensing. Nevada is one of the more overly legislative, for lack of a better term, on how they look at, if you're an interior designer, you need to be licensed with the state of Nevada. And so what they're saying is, hey, we're going to lessen Nevada's I guess stranglehold on these things. So and that's something, if that applies to your businesses, you might want to have on your radar. AB 363, you Airbnbers out there, guess what? Now you're if this passes, you're looking at having to collect occupancy taxes like the hotels. AB 486, talking more about the eviction moratorium. And then there's some things done in the special session that, unless you're in mining, probably don't apply to you. But what I would say is, what the last three governors for Nevada have done is they've divided and conquered industries, and they've just attacked ones different depending on session. Now mining is under attack, and there's actually three proposals that are, it's AGR 1, ACR 2, and then there's a Senate one that we'll get to in a minute. That no, I'm sorry, the AGR 1 is about taxing mining. Again, you can look at that, see if that's something you're interested in or not. ACR 2 is basically, if you know me, you know that I'd rather have less government rather than more government. But ACR 2 says, hey, you can't have a 1.5 year emergency without having some checks and balances in there. That's something as a business owner, if you have an opinion on, I would encourage you to weigh in on, one way or the other. And then the SBs, SB 5, worker freedom makes changes relating to telehealth. And so basically a lot of health providers and our clients, they really went from in-person to telehealth, and they're just catching some legislation up on that. SB 44 behavior proposes to reduce the occupational license burden for certain behavioral health professionals whose business, so there's winners and losers in COVID. Behavioral health, mental health, they've just never been busier because everybody's locked in their bedroom doing Zoom meetings all day. SB 75, unemployment insurance. So Dieter, that was just a mess of getting unemployment benefits, folks. It's still not fixed, and they're saying, hey, we need to restructure Dieter. SB 117, economic development, and so this is amend the reporting of abatements and stuff around GoEd. If you have an opinion on that, they're talking about changing how issuing these incentives are happening. SB 150, and I'm almost done. Requires local governments to designate certain zones for tiny houses. So on the one hand, they're proposing impeding ability to evict people, but then they're like, well, this affordable housing thing, like it's a thing. So we're just going to allow for these tiny houses and to bypass single family zoning laws. And kind of what the idea is, you can build these tiny houses and it's more affordable. Now, of course, I guess I do have an opinion that you can also roll back regulations, building code to a prior version without really impacting safety at all. If, for example, if you're doing an affordable housing project today, it costs you more to build it just because you have to put a makeup air unit in a multifamily affordable housing because the building is so tight it can't breathe, and so you can't get oxygen in there. So you're actually having to force air in. And it's actually too efficient, is what the builders and county folk would tell you. But you could do that and help the affordability thing. SB 209, basically putting more onus on employers to give paid leave. SB 218 continues to cut away property rights, a slew of new regulations. Like, for example, right now we can charge as a landlord, you can charge a rental application fee. But so they're limiting what landlords can do. And just parenthetically on that, the cost to build multifamily in Northern Nevada right now, okay, you're all in, is anywhere from 200 to 250 grand a door. So if you build a fourplex, it's $1 million. So I thought about it. So I was looking in San Francisco at multifamily, and guess what multifamily in San Francisco is selling for? 200 to 250 a door. And they have rent controls in San Francisco, and San Francisco is not a great place to live anymore because of the homelessness. And what you can, they significantly eroded property rights for landlords. So, and that's where, and I wonder, it's like, well, gosh, I built a certain amount of wealth in real estate, but these things, how will they impact a landlord's or owner's ability to sell these things or to make money on them, and how's that going to impact valuations? I think those are larger issues that really we're not talking about as we become California light in many ways, and I just want to put them on the radar to consider having this discussion. And then SB 276 imposes technology fee for insurance issuance of renewal of certain licenses. Basically with MPRA saying no new taxes. And last two, SB 293 prohibits an employer from seeking, this is classic, from seeking information relating to an applicant's salary or wage history. So if you ever interviewed somebody, you're like, so what have you made in these jobs? So that way you can give them a little bit of a bump. They're saying SB 293, you can't ask that question. Now it's like asking what their sexual preferences, it's off limits. So it was interesting. SB 335, professional occupational licensing, is really, this is Joe Hardy, who actually I had his grandson work for me years ago, a good guy. And he basically said, hey, we're going to model our occupational licensing after Utah. And that's something that I think if we could streamline some stuff in Nevada, that would be a really good one. Joe's party is not in favor in Carson, so who knows where that's going to go. But we shall see. I did want to leave enough time for questions if you have.
Somewhere you had said, I think in your NNBW column, that Biden was expecting a certain amount of revenue from all the tax changes, but your guess was that they wouldn't recognize as much revenue as they thought because people would start planning to deal with the changes.
Right. Yeah, that has been a common theme both in state and federal history when they do the math, assuming that, well, this is how much taxable income was reported, this is the increase in the rate, A times B equals C, this is that the revenue disappears. And it's because people plan. As soon as taxes go up, you see, the CPAs and tax attorneys get business. So my number and email, I will throw that in there somewhere. Yeah. Dave, when we first met, I used to be able to multitask like no other. I just any other thought? I'd be curious to poll the audience on where they see their own business, or flourishing, or is it Strug City, where they see it. Linda.
So is there any kind of tax rules as far as how long you can stretch out selling a business? How many years?
Actually, there's not. So that's where it's like, think of it. So like many businesses, in fact, the rule of thumb as a business broker is take what money you take from the business. That's called seller's discretionary earnings. Multiply it by 3. That's going to give you a thumbnail of what your business can sell for. Mm-hmm. 3 years of earnings. Well, so if you say, well, hey, I'm going to spread that over 6 years, 10 years, 30 years. Fine. It's you can then get the right income in the right year. So yeah, you're not limited. The only limit you have is, obviously, the longer it is, the more risk you have that the thing's going to continue to be able to make enough money to pay you for it.
Okay.
Good question. So Linda, as a financial advisor, I was curious how what your thoughts on where you see the market and things clicking along this next year.
Yeah, it's definitely getting more and more volatile. I know you said that the ticker for measuring volatility is the highest it's been in a long, long time. So, it's kind of one of those things. You just look at your time frame of how long the money's going to be set for and invest accordingly. So,
right,
gonna rock and roll for sure.
Yeah. So how much cash or non-volatile stuff do I need to have so to not have to worry about it?
So a good rule of thumb is at least 6 months, And if you have more complex situations like a whole bunch of rentals and so on, then you want to even consider more.
Right. Yeah. Yeah.
Good question.
Mike, do you see any changes happening in California that are going to either make them more or less attractive? Hard to see them becoming more attractive, but do you see any tax changes happening over there?
No, actually, the one that has been the biggest threat from a California perspective is they've really tried to pass this initiative that says if you have appreciated property that you do an exchange out of in California. So you exchange California property for non-California property, then you move out of California, that they're saying, oh, no, we get a piece of that pie once you finally sell it. And it was big. And if you have other wealth, I think it was at 10 years. So if you make any money for 10 years after you leave California, you have to pay that to us. So it is it really they really do operate like a separate nation as far as how they view the world. And they're like, no, it's our way or the highway. And which is exactly how the United States does it, by the way. U.S. one of the only, I think, 2 countries that tax worldwide income. And so there's and if you leave, you have to pay a toll to leave the country, to renounce your citizenship and take assets offshore. So was there another question? I see Rich's. I can hit that. Is there a cap that comes into play on installment sales less than $1 million? Under the new proposal, it's $500,000 of gain, and as I mentioned, it's questionable whether or not that gain is per person. So would that be $1 million for a couple? That'll have to be, kind of riddled in as it works its way through the House and the Senate, and then as those are reconciled. But there is currently no cap on that. I was supposed to do a shameless plug for my radio show. Saturday at 10, I have Bosma on Business. We do this every Saturday. I have business owners on. If you have an interest in give something to share, would love to have you as well. Yeah, Dave, you were saying something.
One or both every weekend when I ride my bike, and I always learn stuff on your show, and you always have fascinating guests. So I highly recommend it.
Okay. That's the best. I'm gonna lift that from the recording and probably use it everywhere. I'll give you a promotional fee, Dave. Thank you.
A deal.
So I'm actually looking forward to getting back to the radio show on in person. Right now, it's COVID protocol for Cumulus says only I can be in the studio, but they're thinking in a week or two we'll be able to get people back in the studio. It is interesting, doing stuff on Zoom. You lose some of the interpersonal energy and so it's just it's got a little bit more pop in it when it's in person. I say, so you can see if they're on the phone, you can't see them wince, right? Like, oh, what did I just say? Sorry. If there's any way we give it, our give back to the world is we give an hour of our time, no charge or expectation. I just like to help people. So all I do is have people, you have a tax situation or you want to look at your business, get it valued, whatever problem you have, I'll give you an hour of time to try and figure it out. So I do everything I can in that hour to help you. And then, sometimes they become clients, otherwise not, but you just try and help people move their agenda forward.